Hello, and welcome to this rather special episode of Mondays with Matthew. I'm Windermere Real Estate's Chief Economist, Matthew Gardner. Now, if you're wondering what's special about this particular episode, well, the answer is twofold. First off, I started these videos at the onset of the COVID-19 epidemic back in March, and this is the 35th episode of Mondays with Matthew. Where has the time gone? Anyway, it's actually going to be the last one for this year, and I wanted to take just a moment to thank all of you for taking time out of your busy schedules to watch my videos. It makes this Economist very happy to think that you are still getting value out of my musings. But there's another reason that I'm excited, and it's because after many late nights poring over numerous spreadsheets, I'm now ready to share my 2021 US housing forecast with you. So, without further ado, let's get straight to it. I'm starting off with my mortgage rate forecast. As you will all be very aware, we've spent the entire year watching mortgage rates break record lows almost every week, which, along with several other factors, has helped drive housing demand significantly higher. But how low can rates actually go? Well, my forecast suggests that rates will likely bottom out in the current quarter. But that said, I certainly don't anticipate them rising much as we move through 2021. Now, I always like to see how my forecasts compare to others. So I spoke with a few housing economists across the country to see where they were regarding rates. And as you can see, we are all in a pretty tight range for next year. I will tell you, my friends over at Fannie Mae, well, they were pretty defensive about their very optimistic forecast. I guess we will see. And looking further out, where my crystal ball fogs over just a little, the brave souls who are putting out forecasts for 2022, well, they're showing rates not moving much higher even then. Fannie Mae is still coming in at an average for that year below 3%. Wells Fargo, just over 3.1%. And the Mortgage Banks Association a little higher still at 3.6%. The bottom line here is that we are all pretty confident that although rates will start to rise, the increase will be modest. And I personally don't see it impacting housing demand at all. And to explain why we will see rates rise, well, 30-year fixed-rate mortgages are pretty directly correlated with the yield on 10-year treasuries. And you can see here that my forecast shows these rising, albeit modestly, next year. And naturally, if this occurs, rates should follow. But there are two reasons that might stop rates rising, at least by too much, even if we see Treasury yields heading higher. First, COVID-19 vaccines. You see, if it takes longer to distribute the vaccine, or if a lot of us choose not to take it, then the economy could take another dip. If this happens, Treasury yields will likely pull back and rates could drop again. But I actually do remain hopeful that this will not be the case. Second, the Federal Reserve. As long as they continue to buy mortgage-backed securities, well, rates are actually insulated from rising Treasury yields. Okay, on to sales. And here I'm specifically looking at existing homes. I'll address new homes shortly. My forecast here is for sales this year to have risen by 3.9%, but sales in 2021 should be up by 6.9%. Now, for perspective, that's a level we haven't seen since 2006. But in order for sales to rise to this extent, we need more inventory. I do expect to see more listings next year, and it will likely be, at least partially, due to COVID-19. There'll be some households who will decide to move because they either no longer need to live in their current location because of their newfound abilities to work from home. But I think there's actually going to be others who will decide to move because their current homes, well, they're simply not set up for remote work. But I also think that households who are looking to sell because of this newfound ability to work from home, well, I don't see all of them moving that far away. You see, the theory that we will all be working from home full time, well, in my opinion, I think that's likely overblown. You see, I would contend that a lot of people will end up blending their work weeks. Some days working at home, other days at their offices still. Now, if I'm correct, I see many households They will move, but they're still going to stay within reasonable proximity of their workplaces. Turning our attention now to sale prices. Well, this year has been very impressive so far, and we should see sale prices in 2020 ending up 7.4% higher than we saw in 2019. Now, this really is quite remarkable. And I say this because I took a look back at my 2020 forecast, the one that I put out about a year ago. And back then I was forecasting price growth closer to 4% than 7%. But COVID-19 changed all that. Mortgage rates dropped. Households decided for several reasons to move, and in concert with an historically low level of homes available to buy, prices have risen significantly. Now, as I've said for years, there must always be a relationship between incomes and home prices, and mortgage rates dropping can only allow prices to rise by so much. And along with other factors, it's partly due to affordability issues that I see prices rising by a more modest 4.1% in 2021. Okay, looking now at the new home market. And for the purposes of this discussion, I'm just going to look at the new single-family market. Well, so far this year, we've seen a very significant jump in new home sales, and this very robust demand has encouraged builders to start construction of more homes. And my forecast here for single-family housing starts shows them up by 8% this year, but I'm seeing starts up by a massive 16.4% in 2021. Now, this is good news for several reasons, the biggest of which is that more new construction will add to supply, and that should take some of the demand and price pressures off the resale housing market. And with more starts, I expect to see sales rising too, up by 21.5% this year and a further 18.7% in 2021. Now, notably, this is going to put new home sales next year again at levels we haven't seen since 2006. But I do have one concern regarding the new home market. My worry, well, it's all about cost. You see, builders want to do what they do best, and that's build homes, but they have to reconcile the cost to build a home, which are extremely high today, with prices that would-be buyers can afford. Now, I see them managing this issue by looking to areas where land is cheaper, but where there's still demand from buyers who, as we've been talking about already, are looking at markets further away from the major job centres. The bottom line is that the new construction market, well, it's going to be very, very solid next year. And finally, well, it's going to be remiss of me if I wasn't to address the one thing that's troubling a lot of brokers and their clients, and that's forbearance. Although we saw a modest uptick in active forbearance plans earlier last month, I think it's important to put things in perspective. Despite small increases in the number of homes we saw entering the programme, the number of active forbearances is still down by 8%, or roughly 246,000 homes, from just the end of October. In total, as of November 30th of this year, there were 2.76 million homeowners in active forbearance plans, and that represents approximately 5.2% of all mortgages out there. But again, for perspective, the number of owners in forbearance, well, it's down by almost 2 million from the peak we saw back in May. That's a drop of, 42%? So let's talk about this for a bit. As is human nature, there are some out there who are predicting the housing market is going to crash again purely because of the number of owners in forbearance, and that all 2.76 million of them will be foreclosed on when forbearance ends next spring. Because of that, we'll see a flood of foreclosed homes coming onto the market. That's going to lead to a massive spike in supply, and this is going to lead prices to drop in a manner similar to that we saw when the housing bubble burst. Well, okay, I get the theory, and I guess that at face value you might say that it seems plausible, but is it? Well, although there's no getting around the fact that foreclosures will rise next year as forbearance terms end, will it really be that dramatic? I think not. And there are several reasons why I'm not overly pessimistic about this. Although I do see foreclosures rising next year, I actually expect the numbers to be very mild when compared to the veritable carnage that we saw between 2008 and 2010. And why do I think this? Well, the housing bubble burst for very different reasons than we're currently experiencing. Back then, there was a frenzy of reckless lending, irresponsible borrowing, and unbridled speculation that did nothing more than set the housing market up for a crash. And crash it did. Home prices collapsed, millions lost their homes. But look back to March of this year, when COVID-19 really kicked in. Homeowners were actually in a very good place. Credit standards, very, very tight. Down payments, very significant. And the housing market, along with the economy as a whole, was extremely healthy, and that's the difference. The COVID-19 pandemic has primarily hit renters, we know that, but it certainly has impacted a lot of homeowners too. And as much as I'm very sorry to say that we will see a rise in mortgage defaults and therefore foreclosures, but as the housing market muscles its way through the current economic downturn, I see foreclosures forming more of a trickle rather than a flood. And to support this, I checked with my colleagues over at Atom Data Solutions, and they put a forecast out recently that suggests that more than 200,000 homeowners are likely to default next year. But if there's a longer coronavirus-related slowdown in the economy, well, then the foreclosure count could get as high as 500,000. But as dramatic as their projections may seem, it's worth noting a couple of things. One, during the Great Recession, foreclosures spiked, with 1.65 million American homes going into foreclosure just in the first half of 2010. Now, this is well above the most pessimistic forecast for foreclosures next year. And even if defaults do rise dramatically, I see them coming in well below the levels we saw following the bursting of the housing bubble. Two, and as I've talked about earlier, home prices have risen steadily since 2012. And because of that, homeowners have built up very large reserves of equity. Now, this is the total opposite to the situation we saw in 2008. And it's because home values have been rising that a lot of borrowers in forbearance I see as being able to escape foreclosure by simply selling. We know there's more than enough demand out there. I think that they're going to sell to make sure that they get the equity out of their homes rather than potentially to lose it through foreclosure. Third is that I really see lenders having no stomach for a repeat of the foreclosure crisis that we saw a decade plus ago. You see, today I'm seeing lenders positioning themselves to use a more cooperative, less punitive approach to delinquent borrowers, and that they're actually going to do a better job of keeping people in their homes. Finally, many, not all, but many of the owners in forbearance, they're not going to enter foreclosure because they will be able to catch up on the past due amounts by paying more each month. And there will be others who will be allowed to add the past due amount to the end of the mortgage by lengthening its term. The bottom line here is that the housing market and homeowners are in a much better position today than they were back in the bubble days. Homeowners today have far more options to avoid foreclosure. Equity is certainly helping to keep many of them afloat. Put it this way, even if today's rate of foreclosures doubles, it'll still only hit a mark that's more in line with historic normalized ranges. Ultimately, I'm not concerned that we will see a housing market collapse because of forbearance. And finally, a few more nuggets to think about. Even if we ignore concerns over forbearance, well, there are other people out there who are talking about a housing bubble forming purely because prices have risen so rapidly over the past several years. But myself, along with many of my colleagues, we just don't see it. Now, it is true that prices have been rising at above average rates, but fundamentals are still in place. As I mentioned earlier, borrowers are well qualified and they've got solid equity in their homes. But as I've shown you, price growth is set to slow. And I think that because of this slowdown in price increases, while there will surely be some home owners who will think that the housing market has collapsed for one reason, And it will be only because their real estate agents aren't telling them what they want to hear as far as the value of their home is concerned. What they need to understand is that the market isn't collapsing. It is just normalizing. Now, sellers have had the upper hand for a very long time now, and I think many may have forgotten what a normal housing market looks like. In the early days of the pandemic, it is certainly true that buyers did gravitate toward the suburbs. And we know this because, according to the National Association of Realtors, 57% of buyers who bought between April and June of this year, they chose suburban locations. And this compares to 50% below the pandemic. But 50 to 57? Well, it's hardly the exodus from cities that some had speculated. And I would also note that there was even a small uptick in urban home purchases in that same 3-month period. 12% before the pandemic, 14% after. Now, meanwhile, sales actually fell a little in small towns and rural areas in the same time frame. So no, I'm not anticipating a massive move by every household out to the countryside. Yes, now you've heard this from me for a very long time now. First-time buyers will be a major force again this year, and for years to come. Brokers need to figure out how to work with them. Their numbers are only going to grow. Condos. Well, this one's interesting. Now, although I don't see the condo market collapsing across the country, although certainly there are significant issues in several markets, and examples of this would be Manhattan and also San Francisco, but I am seeing inventory levels rise fairly significantly across the country. Now, this is in direct opposition to single-family homes for sale. And those numbers continue to drop. But at least for now, there still appears to be demand because sales are still higher for condominiums too. Now, my concern, well, it's really in regard to the urban condominium market. Now, you see, for many, the primary reasons to buy a downtown condo are twofold: convenient access to work and lifestyle. Well, some won't have to live close to work if they're working a majority or all of their time from home. And secondly, well, if we lose some of the lifestyle reasons to live in a city, the access to restaurants, retail and the like, well, doesn't that take away some of the rationale behind buying a downtown condo? Ultimately, I think there's no need to panic yet, but I for one will certainly be watching urban condominium markets across the country to see if demand continues to keep up with rising supply. If it doesn't, then we may well see prices softening as we go forward. And finally, well done! You made it through 2020. So there you have it, my 2021 US housing forecast. I really hope that you found this video and the ones I've published before to be of use to you and your clients. As always, take care out there and remember to wear your masks, please. But in all seriousness, no, it really has been an honour to speak with all of you this year. And hopefully we will meet again in person this time at some point next year. So between now and then, stay safe, have a wonderful holiday, and here's to a great 2021 for all of us. Bye now.